Now, if you've been struggling with daily bias, this is one of the videos for you. And this is one of the easiest ways to actually predict the next day or to form your daily bias. What am I talking about? This requires you to have a fundamental understanding of what a swing high or a swing low is. And if you don't know what a swing high is, it's technically a three candle formation. So a swing high and a swing low involve three candles. And I'm just going to rudely depict these three candles to show you how it's going to look like. So this is an example of a swing high. And in a swing high, we have the candle to the middle. The middle candle should be higher than the one to the left and the one to the right of it. And when you inverse this, this is going to be a swing low. So we have something like this. Now the color of the candles don't really matter. What matters is that the candle in the middle is lower or higher than the rest of the candles. So it's going to typically involve three candles. And when you look at my chart, for swing highs, I have them on red, and for swing lows, I have them on green as dots. All right. If you're looking for this particular indicator, I think it's free on TradingView, and the name of the indicator is Fractals by Nephew Sam. So if you just type fractals, then Nephew Sam one is the one that you're going to get. So if you put this on your chart, you're going to see the same thing. Now let me remove drawings and then show you guys what we're talking about. So we are on GBP USD. This is on the Wanda chart if I'm right, and we're on the daily time frame. Now, if you want to use this particular method or strategy or whatever it is you'd want to call it, of trying to determine the direction of the next day, then you'd be wanting to do this on the higher time frames. By this, I mean the daily, weekly, and then the monthly. And if you want to just predict the next day, it's very easy for you. You use the daily time frame and don't go lower. Because any time frame lower than the daily time frame is an intraday time frame, and then the move is not going to last that long on an intraday time frame. In as much as price is fractal, the more we get on the lower time frames, the weaker this idea is. Now, what does this idea entail? This idea entails that a swing high or a swing low is going to be a point of reversal for the market. And the market reverses at key points. So what do I mean by those key points? The market reverses at PDRAs, or the market reverses after we have taken out after we run stops. So if price at the PDRA or price has run stops, you're looking for the formation of a swing high or a swing low. Then when that happens, what we want to do is that the candle involves the formation involves three candles. So if we have this at the key level, and by key level I mean PDRAs or after stops have been run, and then we see the formation of a swing high or swing low, what we want to do is that we want to trade the fourth candle or the fifth candle in that direction. I hope you guys get me. So let's look at this particular one. And this is GBP USD, like I mentioned, and one. Okay. So like I said, we want to see price run stops. So I'm going to start from this point in price action. Whichever point I choose to start from, we'll still get good examples. So we want to see price either run stops or we see price be at a key level. And by key level, I mean PDRAs. By PDRAs, I'm not going to mention all of them. I've listed a lot of them on the channel. We have order blocks, we have fair value gaps and stuff like that and stuff like that. Okay. So this is the very first swing high that we have in the market. And when we have swing highs, what is going to be resting about swing highs? Buy stops. So now the market rates these buy stops, and then what do we see? We see the formation of a swing high. One, two, three. This candle is higher than this, and also higher than the high of this candle is higher than the high of this one, and also higher than the high of this one. So we have this. So now, typically with this, we want to trade day 4 and day 5 because if we have this formation, day 4, most likely, most of the time, day 4 is going to be your explosion. So we have one, two, three. So we've rated stops. We're anticipating a reversal according to the swing formation because we said it's going to be a sign of a reversal. So one, two, three. Then the fourth candle, boom, lower. The fifth candle, lower. So on the fourth day, we can predict sells. And the fifth day, we can also predict sells. Now let's see what again is happening right here. We rated these stops. And then we formed this swing low. One, two, three. So after we form this swing low, we are going to expect the market to reverse. So on this fourth day, what do we expect? Buys. And on the fifth day, what do we expect? More buys. Same thing. We have the market run these stops. One, two, three. This was a swing high. One, two, three. And the market ran these stops. After running stops, one, two, three. What do we trade? We trade the fourth day. We would have gotten a sell here. It's not the most explosive move. Could have also gotten a sell here. It's also not the most explosive. Looking at this, not a big range. Looking at this, also not a big range. But now we have this fair value gap right here between this candle and this candle. I'm not going to explain what PDRAs are in this particular video because this video is just to show you how to determine the direction for the next day using this model. Okay, so it's going to be quite accurate if you are going to use this model and you're going to respect that this is the model you're using and you're not going to be chasing any other things in price. So this is what we see. So we see price tap into a key level, one, two, three. And we're going to trade the fourth candle for sales, the fifth candle also for sales. Now, when we see price move past this point, nothing has been formed yet, no swing low was formed. So after moving past this point, we moved, I mean, we moved past this point, then we formed a swing low after running these stops. So, like I said, either price has run stops or price at a key level. So now we run these stops here, we form a swing low. One, two, three. This candle lower than these ones. So we just look at the green dots over here. What are we trying to trade? We're trying to trade the fourth and the fifth candles. On day four, we could have gotten a buy all the way to this point if we are probably held up to the close of the market, and this would have done us dirty. But on day five, buys again. Now the market again is in a key level here, which is the market that completely filled this fair value gap. And what do we see? We see a swing low, a swing high formation. One, two, three. This is higher than this and also higher than this. So what do we anticipate? We want to trade day four and day five. So this is day four, this is day five. So sells, sells. So you see how we keep predicting the next day by using this model? Okay, now let's see what happened last week. The run stops, this was formed inside an order block. I personally wouldn't have taken this buy off of this model. I would have used something else to predict this buy. But then, because I didn't run stops, I also don't really like where this order block is. So yes, but we have one, two, three, a swing low form, and we go by trading the fourth candle and the fifth candle. So this week we'll see what the weekly will do. But this is basically what I wanted to show you guys using swing highs and using swing lows to frame the fourth day and then the fifth day inside of your trading, and you're good to go when it comes to daily bias. This is hands-on, one of the easiest models you ever get. And I'll see you guys in the next one. Don't forget to leave a comment if you've learned something new, like the video so you recommend it to um so YouTube recommends it to other people inside of the trading space. Have a good trading week and may we make some money.